All right, I want to share a few words about consensus thinking and how you can use it to get better at investing, and sort of how to be meta about consensus thought and consensus thinking to figure out what everybody else thinks and then kind of adjust from that. So I'm going to talk about the idea in a couple of different contexts. One is sort of a context that anybody can see, which is if you look up earnings estimates for a given company, you can get them off of seekingalpha.com, or when I was working back in my professional days, we had Bloomberg terminals and we could pull up analyst estimates for any given company. Any widely followed, widely traded stock would have many analysts following it, and so you could look at the average earnings estimates for, say, next year and the year after. It would give you some sense of what the collective consensus thinking was on that company's prospects. And if you remember our video on variant view investing, one way to approach consensus thinking in that domain is to see if you have a completely different, meaningfully different view on the prospects of a company from the consensus thought, and you think there's a very good argument for your case, you might make an investment in that stock or sell that stock, depending on whether you thought the actual results would be much better or much worse than consensus. So this is one way to approach consensus thinking and how I actually did it when I was in my professional years. There's sort of more to it too, because there can be consensus favoring, say, a given sector or a given industry. And so, for example, in the late 90s, you could make an easy argument that technology was where to be. And that was a consensus holding. Almost every mutual fund had garden variety, Cisco, Oracle, Intel, different telecom companies. These were sort of the garden variety stocks that everybody had to have and everybody did have. And these companies were basically owning all the same stocks. And so another way you can kind of detect sort of an excessive consensus favoritism for a sector, for example, is when you go through mutual fund holdings, and you can pull these up online or on any website like seekingalpha.com. You can look at the top positions of any mutual fund. You start seeing Amazon, Facebook, Apple, Netflix, Google in the top 10 holdings of a bunch of different funds, especially the biggest ones. Okay, that's kind of consensus thinking. And actually, you could probably make that argument right now that too many funds actually own the FANG stocks, Facebook and Apple, etc. So that's a consensus position right now. Now, one thing to keep in mind, consensus, just because something is a consensus thought doesn't mean it's wrong. It just means that everybody thinks the same thing. And the way to think about that is, if you have a stock and everyone else agrees with you it's the greatest stock in the world, probably everyone else is already long that stock, and so who's left to buy, right? So you don't want to see too much agreement in, say, an investment idea you have, and you don't want to see everyone else already in bed with you on a given, say, sector of the stock market or a given collection of major companies. It doesn't mean it's wrong. It just means that there aren't incremental buyers for these stocks or for this sector. And so I think whenever you start to see too much consensus thinking, either in a sector or with a company, or as we'll see with the stock market in general, we'll get to that in a minute, you want to start peeling off your exposure to those companies, because what happens to consensus thinking is it starts to get its own velocity, and then it becomes kind of, what would I say, like over bullish, and it goes off a cliff. And so everyone who was bullish on the same tech stocks in 1999, by mid-2000, they were putting up terrible losses, terrible results, and that tech correction didn't end until 2002. So you really went over a cliff if you were long all these same garden variety tech stocks back then. Now, I'm not saying that's going to happen any minute now with, say, FANG stocks, but it's a thing to watch out for, because you don't necessarily have incremental buyers to keep driving these stocks higher and higher. At some point, that's going to run out. We're just not going to know when. So these are kind of different ways to think about consensus. And then just keep in mind that consensus is not always necessarily wrong. It's just a collective agreement. And what you kind of want to think about is, if you have a new stock idea, you want to make sure that not everybody agrees with you. You kind of want to, like, let's say you're talking about with other investors about a new stock idea you have, and they give you a blank stare or nobody agrees with you. That could be a good sign, actually, because it indicates, it kind of depends to what extent the people you're talking to are consensus thinkers. So this is another nuance to think about. But if you have some friends who are kind of, they think like everyone else, or they're not particularly on the cutting edge of investment thinking. Those are people to sort of make sure they disagree with you a little bit with an idea you have that might be a little bit out there. And likewise, if you have some friends who are very, very insightful, and somebody says, oh, that's a consensus stock like XYZ company and all these mutual funds already own it, that's really, really useful to know. And that's a friend to sort of ask for his opinion, because his or her opinion, because that person might have a good sense of what consensus thinking is in a given domain. So these are different ways to think about it. And then I guess the final thing is to think about consensus thinking in kind of a collective sense about the stock market. And here's where I want to talk about the magazine indicator. It's a very, very kind of, I don't know, sort of a famous thing that shows up periodically in the history of the stock market. A great example actually was in the early 80s, there was a famous Newsweek magazine cover called The Death of Equities. And it basically was an article saying how equities were poor investments and they'd been underperforming for a long time. And when you see an opinion like that, filter out into the general media and make the cover of a magazine, it's probably a consensus thought. And ironically, that was almost to the month, the bottom of the 1980s, the 1970s and 80s bear market. And then we had the great stock market boom from the early 80s right until 1999. So it actually kind of was the mother of all indicators to lean the other way. Here's what consensus thinks. Everybody thinks this. It's a really consensus idea. It's time to start leaning the other way. So these are kind of applications where you see what the consensus thinks. It might or might not be wrong, but it's probably something you don't want to be totally in step with. You don't always want to be in a place where everyone agrees with you, because that can be dangerous in the stock market. So keep that in mind. Know what consensus is, find different ways to identify it, and try to avoid it as best you can. All right? So thanks as always for watching, and I hope these videos are helpful.